What's going on, everyone? Charlie here. We have a pretty big filing out of the National Securities Clearing Corporation. This is SR NSCC 2022-009, and this is to adopt intraday volatility charge and eliminate the intraday backtesting charge out of the NSCC. Let's go ahead and take a look. So the purpose of this one, NSCC is proposing to enhance its clearing fund methodology by implementing an intraday volatility charge that may be collected by NSCC to mitigate, there's that word again, the risks presented by its members' adjusted intraday net unsettled positions and net balance order unsettled positions, hereinafter collectively referred to as net unsettled positions, due to volatility in a member's own trading activity, referred to in this filing as volatility risk, that may occur between the collection of members' required fund deposits at the start of the day and the collection of members' required fund deposits at the start of the following business day. Now, Supernote 2 says that net unsettled positions refer to net positions that have not yet passed their settlement date or did not settle on their settlement date. So we already know that the SFT service that NSCC just announced will be taking care and financing those transactions. So in connection with the adoption of intraday volatility charge and following an evaluation of the effectiveness of its margin methodology generally, NSCC is also proposing to eliminate the intraday backtesting charge. NSCC would continue to maintain the regular backtesting charge that is addressed on members' start of day portfolio. Now, as part of its market risk management strategy, NSCC manages its credit exposure to members by determining the appropriate required fund deposits to the clearing fund and monitoring its sufficiency as provided for in the rules. The required fund deposit serves as each member's margin. So that's what the required fund deposit is. So whenever you hear about the required fund deposit, think of it as collectively every member's margin put into one big pool of money. In case anything were to happen, it would mitigate the NSCC's risk. Now, the objective, again, of a member's required fund deposit is to mitigate potential losses to NSCC associated with liquidating a member's portfolio in the event that NSCC ceases to act for that member, herein referred to as default. The aggregate of all members' required fund deposits constitutes the clearing fund. So again, required fund deposit, when you add all that together, that's the clearing fund. So the clearing fund makes up all the required fund deposits of the members. NSCC would assess its clearing fund should a defaulting member's own required fund deposit be insufficient to satisfy losses to NSCC caused by the liquidation of that member's portfolio. So again, this is all risk mitigation efforts for what's coming. Now, this is an overview of the backtesting charge. NSCC employs daily backtesting to determine the adequacy of each member's required fund deposit. NSCC compares the required fund deposit for each member with the simulated liquidation, gains and losses, using the actual positions in the member's portfolio. So they're basically paper trading. So it is a good idea to paper trade. And the actual historical security returns. So they use, again, they like to do simulations. It's genius. I mean, it would be stupid not to do simulations if you have the tools to do it. You can backtest things and see potential results before you actually risk any capital. So basically, as a part of this investigation, NSCC pays particular attention to members with backtesting deficiencies that bring the results for that member below the 99% confidence target. So that's the standard in the industry, 99% confidence target, or greater than 2 backtesting deficiency days in a rolling 12-month period. And they use that to determine if there is an identifiable cause of repeat backtesting deficiencies. NSCC also evaluates whether multiple members may experience backtesting deficiencies for the same underlying reason. Now, the volatility component of each member's required fund deposit is designed to measure market price volatility of the start of day portfolio and is calculated for members' net unsettled positions, which are ones that have not cleared yet. The volatility component is designed to capture the market price risk associated with each member's portfolio at a 99th percentile level of confidence. NSCC has 2 methodologies for calculating the volatility component, a VAR charge and a haircut-based calculation. The VAR charge applies to the majority of net unsettled positions and is calculated as the greater of 1, the larger of 2 separate calculations that utilize a parametric value at risk or VAR model, and 2, a gap risk measure calculation based on the concentration threshold of the largest non-index position in a portfolio, and 3, a portfolio margin floor calculated based on the market values of the long and short positions in the portfolio. The VAR charge usually comprises the largest portion of a member's required fund deposit. So all this hype about haircutting, there's no need for it because haircutting is not the greater significant of the two methodologies. The VAR charge is the one to look at. It's the larger of the two, and yeah, it is a margin floor. Now, it also is the largest portion of the members' required fund deposit. So this is the proposal. Obviously an intraday volatility charge, and here's the calculation for it. NSCC has occasionally observed significant trading or intraday changes to market price volatility and significant changes to the size and composition of members' portfolios of net unsettled positions that could cause the amount collected as the volatility charge at the start of that business day to no longer be sufficient to mitigate the volatility risks that such positions present to NSCC. Therefore, NSCC believes it is appropriate to implement an intraday volatility charge that, similar to the current intraday mark-to-market charge, may be collected by NSCC when certain thresholds are met. More specifically, NSCC is proposing to utilize its existing intraday monitoring to determine when the difference between a member's 1. Start of day volatility charge collected on that business day as part of the member's start of the day required fund deposit based on that member's prior end of day net settled or net unsettled positions, and 2. A calculation of the volatility charge based on that member's adjusted intraday net unsettled positions as of a point intraday between the collection of start of day required fund deposit and end of day settlement. And if that exceeds 100%, and the amount would be collected as an intraday volatility charge, calculated as described below, would have to be greater than $250,000. So, the proposed methodology would allow NSCC to measure, the reasoning behind this, the change in volatility charge to determine if such change presents NSCC with exposures that are not adequately addressed by the start of day volatility charge on deposit in the clearing fund. If the threshold is met and NSCC determines it is appropriate to collect an intraday volatility charge, that charge would equal the difference between the two volatility charge calculations. By collecting an amount that is measured as the difference between the two volatility charge calculations, NSCC would be able to supplement the volatility charge already on deposit in its clearing fund with an amount that measures the change in volatility that has occurred since the required fund deposit was collected at the start of the day. So they're basically just assessing their risk, assessing member portfolio activity, because again, it's totally up to them to, if they're going to take up clearing, all the risk falls into their hands. Now, they also have a section in this filing, this titles SFT Service Applications. NSCC, and then they go into background, has, a typo I guess, has filed to establish a clearing service for securities financing transactions, which again, to reiterate, are primarily used to cover short positions and failure to delivers, which is what we were just talking about with the net unsettled positions. So again, they're establishing a clearing service for securities financing transactions, otherwise known as the SFT clearing service, to make central clearing available at NSCC for equity securities financing transactions. Subject to the approval of the SFT proposal and upon the implementation of the SFT clearing service, NSCC would include the intraday volatility charge among the margin charges that are applicable to SFT positions cleared through the SFT clearing service. NSCC would implement this change by amending Section 12C of the proposed Rule 56 to include the intraday volatility charge as one of the components of required SFT deposit of an SFT member, as such term is proposed in the SFT proposal. So that's basically it for this one. There is more in the filing, more substance. I didn't want to get into all the complicated stuff that requires more back explanation, but this is the gist of it. They're tightening risk parameters. They're getting the SFT even more ready to go. The amendment that they're referring to in this filing has already been filed, and it actually just got designated for a longer period for commission action today. So that means another, I believe, 21 days since published on the Fed Register until we'll hear back from that one. So again, all about risk mitigation. Y'all have a good one.